One of the reasons you have a differential between Shanghai gold and say London gold, or forget London gold, it's there, but it doesn't really matter. COMEX spot versus Shanghai gold is because China has capital controls and you can't just go out and buy gold anytime you want it. They throttle it, they organize it, and they release it with allocations. And those allocations tend to cause like a rush. And so the domestic price goes higher. And one of the ways to stop the domestic price going higher is to let that demand filter into the market and not have to be allocated every month or every quarter. You can do it maybe once every half a year. And they're loosening their capital controls a little bit. And in doing that, the Shanghai premium should close relative to the rest of the world.
The numbers don't lie. Gold is trading at a fraction of its historic value when measured against income and money supply, while silver's industrial strains reveal cracks in China's growth model. Vince Lanci draws on research from Jefferies Chris Wood, who compares gold's valuation to U.S. disposable income. By that measure, gold would need to climb to roughly $6,571 per ounce to reclaim the same share of household income it commanded at its 1980 peak. Looking through an even broader lens, using M2 money supply instead of disposable income, the implied fair value for gold rises much higher, approaching $11,900 per ounce. At the same time, Deutsche Bank has published a more conservative outlook, projecting gold to average near $4,000 by 2026, with potential spikes toward $4,300. Silver, meanwhile, could push toward $48 over that horizon. Yet beyond price forecasts, silver's industrial role, particularly in solar manufacturing, presents new challenges. If Chinese producers cannot sell at current prices without incurring losses, it highlights broader deflationary risks inside China. Such pressures could accelerate efforts to reduce silver usage in solar technology, reshaping demand dynamics. On the gold side, China is moving in the opposite direction. The rollout of a multi-pass to ease import restrictions marks a shift toward closer alignment between domestic and global markets. This step reflects Beijing's recognition of gold's strategic role, not only as a reserve asset but also as a stabilizer in times of financial uncertainty. If you found this video helpful, don't forget to like, share, and subscribe to stay updated. We'll continue delivering sharp insights and expert perspectives on the forces driving gold, silver, and the broader financial landscape. Thanks for watching.
Gold, silver, decidedly softer. Well, it was decidedly softer, but looks like silver's giving back a little bit. Gold, silver is 85 and change. Grains are offered to varying degrees. Soy is down 140 basis points. Corn is down 70, and wheat is down 70 basis points. So late last week, Chris Wood, who I've been reading for years out of Jefferies, he's positioned in Asia, and he's very well coordinated with the Asian markets and gold. And he's been, he's one of the older guys doing it for years. Anyway, they adjusted their model and said that gold should peak at 65.71. So let's read a little bit of that. Chris Wood ties gold's secular peak to U.S. disposable income and says the tie will be 65.71. We show money supply math paints a much higher price. Now, Jefferies Chris Wood reaffirmed his long-term gold framework this year, noting the metal would need to reach about 6,600 per ounce to match its 1980 peak share of U.S. disposable income. That report, which we shared, highlights gold's advance from 3,700 today, but frames 6,600 as a secular benchmark, not a trading target. Goldfix did a comparative analysis that shows a more aggressive lens, similar to what other people talk about M2 is. Applying the same method that Chris Wood used, not Woods, using a more aggressive lens, using M2, suggests 11,900 per ounce. The divergence underscores the gap between using household wealth and systematic liquidity approaches. Here's what I mean. In 1980, M2 and disposable income lined up with gold at $880, whatever it was. Over the years, see those lines there? Over the years, disposable income lagged. It's the orange line, the pinkish line, and M2 increased. I would suggest to you that the gap between the blue line and the purple line there, pink, whatever it is, are a reflection of the disparity in buying power of Americans since all that money was created. Between 1980 and 2000, they both have a similar slope in this graphic. But after, say, approximately 2009, after the great financial crisis, buying power remained the same by this measure, disposable income, as M2 ramped. So the question is, will gold go to 65.71, which is tied to our disposable income, prorated back from 1980, or will gold go to M2, which was also tied to gold's price in 1980? Most people would say M2, and that's why we say that even though Jefferies' number is a reasonable, solid target based on disposable income, you got to go with M2. Because every time we talk about this, have this conversation, more and more people are discussing literally going back to a hard money store of value, which is what the yuan is coming. So whether inflation or stagflation for the economy, gold's long-term ceiling may prove much higher than most expect. Full analysis is in the premium post. Jefferies, gold to peak at 65.71, and why that might be low. Third story, Deutsche Bank gold to average 4,000, silver 45 in 2026. The mainstream legacy media had some headlines to the effect last week that gold to go to 4,000 and silver to $45 in 26. No, it's gold to go to 4,300 and silver to go to 4,800 in 26. China solar downgraded on overpricing and weak demand. This is a concern. You know, one of the things that people that are that think China is struggling, and China is struggling from many points of view, is that, you know, China, if China can't sell stuff to the US, who's it going to sell to? Well, it can sell to all the BRICS, but not at the price that they're charging. So there's deflationary risk in their economy in general, even though their market isn't showing it right now, but in solar specifically. And so Goldman Sachs downgraded China's solar companies, saying their prices are too high, they're not going to move it. And that's a negative for silver. Now, does the market care about it right now? No, of course not. That's down the road type of stuff. It also means down the road they'll be looking for ways to conserve and use less silver in their production. So innovation has got to come down the road. Finally, China's new gold multipass, that's what we call it, loosens import restrictions. One of the reasons you have a differential between Shanghai gold and, say, London gold, or forget London gold, it's there, but it doesn't really matter, COMEX spot versus Shanghai gold, is because China has capital controls, and you can't just go out and buy gold anytime you want it. They throttle it, they organize it, and they release it with allocations. And those allocations tend to cause like a rush. And so the domestic price goes higher. And one of the ways to stop the domestic price going higher is to let that demand filter into the market and not have to be allocated every month or every quarter. You can do it maybe once every half a year. And they're loosening their capital controls a little bit. And in doing that, the Shanghai premium should close relative to the rest of the world. That means Shanghai should drop because there's no more piling in, waiting to get, I need to buy the gold now. I need to get my order in now, as opposed to a more continuous liquidity. And so the Shanghai premium should drop, but the rest of the world should rise. So the whole thing should converge at a higher price if China's demand is real. If China's demand is not real, then it converges at the lower price. And that's the idea. That's what happens. You're creating a more robust market that way. Those are some of the stories that we had out. We want to bring your attention to this one in case you missed it. This is down the road, but not down the road that far the way things are going.
Vince Lanci said that gold has been locked in a 4-month range, with 3,707 emerging as the critical level to watch. He pointed out that this price was set right after the Fed's cut, when the market first rallied, then sold off for 2 days due to Shanghai selling, before turning higher again. He emphasized that if gold stays above 3707, the outlook remains bullish, but slipping back below that level would suggest producer selling is still in play. Lanci also noted that while silver is well off its highs, Fed rate cuts historically provide even stronger support for silver than for gold. Vince Lanci also emphasized that these technical moves need to be viewed through a broader macro lens. He said the real driver isn't day-to-day data, but the Fed's policy pivot. By shifting its focus from inflation to growth, the Fed has already cut rates by 25 basis points and is expected to deliver another 75. Lanci pointed out that this dovish stance changes how markets react. Weak PMI or housing data now boost risk assets, while stronger numbers could reduce the pace of cuts. In his view, that backdrop makes gold and silver's technical behavior even more important in signaling where markets are headed next. Let's get back to the interview.
A month ago, Michael Hartnett said he believed gold revaluation would happen, and he said why it would happen. And we had been studying that for a while as well, and he doubled down on it when people said it wouldn't happen, like Scott Bessent. And so we broke it down with some graphics. And in case you missed it, if you're wondering why gold's rallying, well, maybe the concept of revaluation is a problem for people that don't own enough gold. Coming soon, rethinking the 60/40 portfolio. Morgan Stanley basically came out and stole a page from, I wouldn't say stole, borrowed a page from Goldman Sachs. Goldman Sachs about a month ago said quoting them, the 60/40 portfolio is dead. And so they were saying, without putting a number on it, they were saying you need to swap some bonds for gold and swap some bonds for oil, but mostly gold. And they were basically saying it's 60/20/20. Morgan Stanley just puts a fine point on it and it says 60/20/20. And that's getting a lot of press now. I will be writing about that. But essentially, it's the West is being put on notice to buy gold. Have you noticed that? I don't think it's random. UBS raised their silver price target last week. We have that report. UBS reiterates go for gold. They don't change their target there. Post-Fed rate cuts, what to do. That's a piece we're working on. HSBC raises silver targets, but HSBC is way behind the curve on that. They're not raising their silver targets aggressively, but it's interesting to read their fundamentals. And we noticed that the World Gold Council put out two reports, and one was China physical demand is dropping and India physical demand is growing. And we tend to think that they work together on that. Anyway, those are the stories coming this week. This week, data, PCE, which is an inflationary indicator and can pretty much be extrapolated from the previous data. We don't think that's the most important data, at least for the market gyrations, because the Fed is throwing in the towel on inflation, so to speak, and they're focused on the economy now. So PMI and new home sales might be more important this week because at this point, the market is focused on the Fed's dovish cut, 25 basis points with another 75 coming, which is odd because the Fed's now converging with the marketplace. In doing that, the market's now taking cues from now. All markets. And so if you're a stock person, you're looking at that saying, okay, if the PMI comes out bad, bearish news is bullish for stocks. Stocks should rally. If the PMIs come out strong and the economy is doing well, then stocks should sell off. So they're worried about him trimming one of his three cuts. That's how I would take it. Let's take a look at the chart. There's the 4-month range that we charted so well. I mean, if it's not going anywhere, your lines are perfect, right? And here we are now. So we're well off the highs. One of the things we talked about on Sunday, I just sent that out to founders, and I'll send it out again in the CFTC conversation, was, well, there were two things worth bringing up. One was this high, and one of the founders, Nigel, was very focused on it, and he was right to be focused on it because this is the day that the Fed cut, and the market rallied on the news, interpreting it as bullish, and then slammed 1 day, 2 days. And this high was 3707.49 on my chart. And we had a very nice 5-minute conversation about this, and we pretty much all put our heads together, and this is what we came up with. And I said it at the end. I said, okay, this is the Fed high, right? People, paraphrasing Nigel, people interpret it as hawkish based on his speech. And the market came off for 2 days. During these 2 days, Shanghai sold. That's what I observed. And then this day, befuddling everyone, the market just took off again. And so the question is, who was selling here at 37.07? And the answer is either it's a producer that's going to be there after the Fed, or it's someone who isn't going to be there after the Fed because they were just selling into these two days lower. And so our conclusion was you buy the Sunday open, which you should have done. Well, you do what you want to do. You watch to see how it behaves during Europe. You're nervous during Europe, right? And then at the 4 a.m. mark, you watch it again because the 4 a.m. mark will be your indication of if there's U.S. buying coming in. And so there is U.S. buying coming in because the market makers bought in anticipation of that. We get above 37.07, and that selling's not there. So your caveat for the rest of the day is you're bullish unless we get below 37.07. Because at that point, then maybe your producer, if it was a selling producer, will come in and say, I'm going to sell it here and drive it down to 37.07 and then stop their selling there. Who knows? But that's what's going on. Silver, well off its highs now, but this is where we are. I mean, Fed cutting is more bullish for silver than gold.
Gold and silver are being shaped by both technical and macro forces, highlighting their continued importance in today's financial landscape. Gold's ability to hold above the 3,707 level signals strength amid Fed policy shifts, while silver's higher sensitivity to interest rate cuts positions it for potentially greater upside. Beyond near-term trading, both metals remain structurally undervalued compared to measures such as income and money supply, with forecasts projecting higher prices in the years ahead. At the same time, China's role, supporting gold through import reforms while creating pressure on silver through industrial demand challenges, adds another layer of complexity. Together, gold and silver stand out as key assets in navigating a system increasingly shaped by debt, liquidity, and central bank intervention. Do you think gold and silver will continue to act primarily as safe haven assets in this cycle? Or could shifting industrial demand and central bank policy cause their roles to diverge more sharply in the years ahead? So, stay tuned for clear, data-backed insights into the financial system. Make sure to like and subscribe so you never miss our weekly updates. Thanks for your support, and we hope you enjoy the video.